Hello my fellow investors and welcome back to another stock analysis video. Today guys, let's actually take a look at another company from Tony Myers, which this one is actually Matson, which is a very interesting company. Just from what I've seen so far guys, they essentially just do things like shipping, rail, truck, like ocean shipping, that kind of stuff. I think they ship like your car. Yeah, like look at this, like they ship your car, they could ship like a bunch of other stuff, so that's fairly interesting. So they pretty much just like help you move, I guess you could say, you know, to other parts of the world or like within the country or something like that. I think that's what they do, at least that's the vibe I'm getting. So let's actually look at this company's fundamentals and see if at the current share price it is looking like a pretty decent buy. So with that said, let's get started with this analysis. And just a quick look on their company profile guys, they don't just do automobiles. Take a look at this. They also do livestock, seafood, general sustenance, cargo, and garments, footwear, e-commerce. They just pretty much do like a bunch of stuff. This is absolutely insane. Honestly, this company is actually kind of cool. That's not, I'm not even going to lie about that. What they do is fairly interesting indeed. But let's actually take a quick look at their earnings, because they recently had earnings as of a little bit more than a month ago on the 2nd of November, which the EPS normalized actual came in at $6.89, beat by 15 cents. The EPS gap actual came in at the same, which is another beat by 15 cents. Revenue came in at $1.11 billion, and which was a beat by $62.55 million. Coming into now the calculator guys, we got the ticker symbol of MATX, market cap of $2.3 billion, a PE of 1.81. That is ridiculously small. And on top of that guys, this share price of $61.58 is very interesting, because looking at the 1 year, they're down 28%. Looking at the year to date, they're down 31%. And the reason why I'm saying this is interesting is because take a look at this 52-week range, guys. $60.32 for the lowest, $125.34 for the highest. Guys, we are at 52-week low. This is a 52-week low company, so this might actually be like a really good opportunity right now to pounce on this. Now coming back to the calculator, they do pay out a dividend of $1.24, which is a yield of 2.01%, a payout ratio of 3.56, a 5-year CAGR of 9.36, and 9 consecutive years of dividend growth. So all of this is looking really good. We're gonna take a look at the payout ratio in regards to the free cash flow in just 1 second. Ex-dividend date unfortunately passed as of November 9th. Payout date was on the 1st, and they pay their dividends quarterly. Now, based off of the total shares outstanding, this is $47.5 million being paid out in dividends every single year. And after this is paid out, guys, take a look at this. They're still left with $83.81 million in their 5-year average free cash flow. And as of their last year's free cash flow, it is $611.31 million. These payout ratios are, well, pretty good, right? Last year's free cash flow, it is only 7.21%, and as of the 5-year, it is 36.17. Now, this is interesting because, well, you guys are gonna see the free cash flow in just 1 second. I took a look at it and it's bad, but then again, it's, well, my whole thing with this company is that like I want to like it, but it's something stopping me from liking it. You'll see what I mean in just 1 second. So let's actually come now into the fundamentals. We got the net income 5 years ago of $231 million, 1 year ago of $927.4 million. That is a massive increase of 301%. My issue though is from 4 to 3 years ago decreasing, and then from 3 to 2 to 1 year ago increasing. So okay, that is kind of normal, right? I guess you could say something was definitely happening here that was causing them to decrease. My issue though is this massive jump from 2 years ago of 193.1 million to almost $1 billion in just 1 year. That is ridiculous. And in fact, if we take a look at the net income, guys, today, it's already at $1.4 billion today. So they went from 193 to 927 to $1.4 billion in the span of just like 2 years. I don't know if that's sustainable. That's my main issue with pretty much all of these fundamentals, is that I do not know if they are sustainable. That is an insane increase. So I am terribly sorry, but I'm gonna have to give this like a 30%. I guess, because I just don't know if it's sustainable. Looking now at the free cash flow, we got 5 years ago of negative 82.1 million to 1 year ago of $658.8 million. That is an increase of 902% with an average of $131.3 million. Again, we get something similar here, right? We actually have this decreasing from 5 to 4 years ago, but then increasing from 4 to 3, then increasing massively, going from negative 61.5 million to $237.5 million, and then another massive increase, guys, to $658.8 million. Now, what is causing this? And this is actually something that I'm going to take into account, honestly, when giving it my grade. And that is that, well, essentially the reason why they actually went into the negative free cash flow, it was because their capital expenditures was just really high. So if that's the case, which, I mean, it is the case, obviously you're seeing it right now on your screen, that's not necessarily a bad thing, because maybe they were just investing back into themselves, which is a good thing that they're doing. So, okay, they kept it around this much. You know what? At least something that they do have going for them is that they pretty much increased their cash from operations essentially year over year. They did have a downturn 3 years ago, going from 4 to 3 years ago, but it's not really that big of a deal. I mean, we saw the same thing in the net income from 4 to 3 years ago, but overall, if that's the case, if the reason why we're getting the negative free cash flow is because they're reinvesting it back into themselves, that's not necessarily a bad thing in my personal opinion. So I'm actually going to give this a little bit of a higher grade to like 65%, I would say. Coming now into the revenue, we got 5 years ago of $2.1 billion to 1 year ago of almost $4 billion, increase of 91.77%. And on top of that, take a look at this: from 5 to 4 increase, from 4 to 3 decrease. This is kind of like a norm that we're seeing with this company. I mean, we saw it right here in the free cash flow. We didn't see that here with the net income, but I mean, 2 out of 3 is like, you know, 2/3 is not bad in my personal opinion. And then an increase from 3 to 2, and then a massive jump from 2 to 1. So it is what it is. I don't necessarily like that jump. That's kind of my issue here when it comes to this. And in fact, if we take a look at the revenue today, guys, they're already almost at $5 billion, currently at $4.81 billion in total revenue. So they just massively spiked up from this 2 year ago value. Again, I do not know if this is sustainable. So because these numbers are actually a little bit closer than like these ones, I'm actually going to give this one at around like a 50% or so. Looking now at the total assets minus total liabilities, this is actually looking fairly good. As of today, they're almost at $2.3 billion in this difference, and they have consistently increased this year over year, honestly. Again, massive spike like we have seen throughout all of these graphs already, from 2 to 1 year ago, and then from 1 to today. So I mean, it is what it is. I think this is a little bit more insulated than the profit metrics, but nonetheless, it's still an outlier. So yeah, I'm kind of hesitant about it, but the difference isn't that much. Average total assets is around $3.3 billion. Average liabilities is almost $2 billion. Doing this difference, we get around $1.3 billion. I'm actually going to give this, guys, like a 70%. I think, you know, yeah, it is an outlier from 2 to 1, but it's not that big of a deal in my personal opinion, and they have been increasing this year over year. Looking now at the cash flow minus the total liabilities, this one's actually looking really good. They reached their lowest point 4 years ago at negative $2.14 billion. And ever since then, they have been getting closer and closer to zero. In fact, as of 1 year ago, they're at negative $1.5 billion. Again, their lowest point was negative $2.14 billion. So that's very, very good. Average cash flow minus the average liabilities, we get around almost negative $2 billion. I'm actually going to give this, believe it or not, like an 85%, because they've only had one instance in the past 5 years where they went really deep into the red, and ever since then, they just been going closer and closer to zero. So that's really, really good. And now coming into the most ridiculous of all metrics when it comes to this company. Not so much for the buyback that they have been doing, but exactly how much this will affect the projections and the target share prices. You guys are gonna see it. You're gonna be like, that's insane. And I fully agree with you. It's insane. But nonetheless, looking at the shares outstanding, guys, in the past 5 years, they have been buying back at almost 10%. 5 years ago of 42.5 million to today of $38.3 million. That is a decrease, guys, of almost 6.6%. Really, really good. Now, they have had years where they increased it a little bit. You can see from 5 to 4 to 3 to 2 years ago, they have increased it, and then from 2, they have been buying back. So they may take even more advantage of this, seeing that they are at 52-week lows. If they buy back even more shares, that will also lower their payout ratio, because they do pay out the dividend. They may want to keep that payout ratio low. And yeah, that's essentially this graph. Is actually looking really, really good. I'm actually going to give this a 60%, because it's true that, you know, they have been buying back. However, they have made a little bit of increases from 5 to 2 years ago. So I think 60% is fair enough. And lastly, when it comes to the cash equivalents, they currently hold $242.8 million with an average of $100 million. Now, looking at this weighted grade, well, the fact of the matter is that we gave the net income a 30%, free cash flow 65%, revenue 50%, assets minus liabilities 70%, cash flow minus liabilities 85%, shares outstanding a 60% for an overall grade of 57%. My biggest problem, my biggest gripe, guys, with this company is this net income, this free cash flow, and this revenue. That's it. And the main issue I have with it is just the outliers. It's just such a huge spike. I do not know if this is sustainable. I just showed you guys that today they have surpassed this. So is it sustainable? I don't know. It may be sustainable this year, but who knows what it'll be next year, right? The year before that, I don't know. So because it is just a massive outlier, that's my main concern, honestly. So if Tony, or if anybody honestly knows the reason why these outliers are occurring, I could say COVID, right? Pent up demand. That's what I'm assuming, and like inflation as well. But if there's any other explanation aside from that, please leave it down in the comment section below, because if that's the case, then this number should be a whole lot higher if we do have a reasonable explanation for this company. Okay, now let's come over here to the discounted free cash flow. And well, guys, remember when I said that the shares outstanding was ridiculous because of the target share prices? Well, you know, doing a discounted free cash flow approach, guys, not making any assumptions, only having the required rate of return of 10%. The target share prices, not adjusting for debt, with no assumptions made, $598.14. Adjusting for debt, it comes down by a dollar. That's it. So, yeah. I don't know if this is correct or not. The reason why this is occurring this way is because they have such little shares outstanding. You guys just saw it. It doesn't even get to 1 billion shares. It doesn't even get to 100 million shares, right? So that's the reason why we're getting these massive numbers. You have such a spike in revenue, such a spike in free cash flow, and such a spike in net income, and then you divide that by such a little amount of shares. Guess what? You're going to have a really, really big number. That is the reason why this is occurring. So take this with a grain of salt. If I put anything on here, this is numbers is going to go up, right? This numbers are going to go up. So let's actually make some assumptions, I guess. Not that it really matters, but let's make some assumptions. Let's come over here to the growth tab. We can see that the forward is 11%. So I'm going to be really conservative when it comes to this. Let's go 2, 3, and 4% for the revenue growth. And then projected share buyback on the 5-year, they've been buying back around 10% or so. Their shares at 52-week low already. So I don't know. Let's just say 0 and 1 and 2%, I guess, in the next 4 years. I mean, if I really wanted to be true to this, I would put something along the lines of like, actually, I am going to do it 5, 6, and 7%. Well, guys, if you believe my assumptions, if you believe my discounted free cash flow, not adjusting for debt, this company should be worth, this is insane, this company should be worth $675.52 at the lowest and $739.55 at the highest. Adjusting for debt, this just comes down by a dollar across the board. Adding a margin of safety of 5, 10, 50%, $573.42 to $701.70. I do not know if this is correct. I'll fully admit it. Full disclosure, no idea. Because again, the way that this works is you divide the future profit metrics by the future shares outstanding, and then that gives you this number. If the future shares outstanding are less than what they are now, which right now they're less than 100 million shares, you're going to get a massive number. That's just the way that the math works out. So again, I do not know if this is correct. Please do not buy into this company, because I'm saying that this should be worth at the lowest 675, and you know the current share price is $61.58. That is almost an 11 times return, which is just insane, right? Absolutely insane. So please take this with a grain of salt. Have this calculator and make your own assumptions, because this is not financial advice and every investment is the present value of all future cash flow. I personally don't know if this is true. Again, this kind of free cash flow works best with nice, consistent, growing revenues without any spikes or very little spikes. Unfortunately, there are massive spikes going on here that also attributes to these massive numbers. So please do not follow what I'm saying. This is not financial advice. Every investment is the present value of all future cash flow. As I always say, have this calculator, guys. I also have the book value. You guys can also take a look at this company based on the book value perspective as well. I also have a reevaluation and a dividend tracking sheet for companies that pay out dividends, or if not, just checking out your capital gains and losses as well. So I'm giving this out for free, guys. Free content. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. Really does help with the algorithm on YouTube. Thank you so much for everybody who have subscribed. I really do appreciate it. I don't take any sponsorships. I don't plan on taking on any sponsorships unless it's like food related, right? Like safe and ready meals, something that you can get tangible, right? Something that you can physically get in your hands and something that you will use. Like for example, safe and ready meals. Like, you know, it's always good to have emergency food at home. So yeah, it is what it is. So I think that's the kind of sponsorships I'll ever get into. If I ever do get one, I don't know if I will, but if I ever do, you know, something like that, something tangible that you guys can physically buy. But yeah, thank you so much for everybody who have subscribed. I really do appreciate it, and thank you all so much. We're up to 1,620 subscribers. It's insane. I would have never thought I would have made it to this point. I really would. So thank you all so much. I really do appreciate it. And now lastly, let's actually take a look at this dividend, because at the $1.24, it's not a lot, but I mean, we just saw the discounted free cash flow, so you know it is what it is. Putting in $5,725, we get 92.97 shares for an annual dividend of $115.29, quarterly of $28.82, and monthly of $9.61. The biggest thing with this dividend is the fact that they may increase into the future. In fact, they have increased it already for the past 9 consecutive years, so they may continue this, especially if they keep going the way they're going. So yeah, it is what it is. Not that big, but you do have a lot of prospects for the future. All in all, Matson, it's a company that I wasn't really expecting to see those kinds of numbers. So thank you so much, Tony. I don't know how I feel about it. If I could get explanations as to why those outliers are like that, right? Aside from COVID, this is looking like an all-out banger right now. Like, if you guys believe that this company will continue to grow their profits like that, right, and not come down in the next 4 years, and continue to buy back shares, or just issue shares but not that much and then buy them back the following year, this is looking amazing right now. It's not even funny. So again, not financial advice. Every investment is a present value of future cash flow. And that will pretty much do it for this video, everybody. Like the video, like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my music sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.